I'm going to show you this in a minute, but my view is that this past week and maybe the past month or so and even year to date has been primarily negative in the market, and I'll show you detail on that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is March 12th, 2025. So let's go into the dashboards and you'll see what I'm talking about. The first view I'm going to give you is from last Friday, which is March the 7th. So as of that day, and the yellow box is the last week, the pink box is year to date. You will notice a lot of this is negative, and the market is negative, and we'll look at the component parts. What's so interesting, I don't think I've ever seen this before. What's so interesting is that the top two ETFs in my dashboard is developed markets and emerging markets. Emerging markets are stronger than the US. Even in a down market, that's odd. So what you see here in the yellow box is the developed markets, mostly Europe and Japan, are up over 3%, and the emerging markets are up over 2%. So, and then all of the US, including the bonds, so the equity markets and the bonds are down between 2 and 4% for the week. That's a lot. And then we go over to the pink box and you see same thing. The top two are developed markets and emerging markets. And then you drop down to bonds, up 3%. And then the Dow is up slightly and everything else is negative, all the way from 1% to 6% year to date. And year to date is 2 months and 1 week. So that's not a lot. Over in the red dot, green dot area, above or below its moving averages, 20, 50, 100, and 200, you can see that there were 11 green dots out of 28 compared to 14 last week. And so it's generally moving in the direction of a pretty negative market, especially in the US. When we get to the sectors, the component parts, as of last Friday, you see the yellow box again. We go from a slightly negative all the way down. I guess financials were the worst, over 5, almost 6% negative for the week. Wow. And of course, healthcare was slightly positive, very defensive. So, and then year to date, healthcare was the top of that, consumer staples, two of the most defensive sectors out there, and then some of them were positive. And then you get all the way down to technology, minus 6%, consumer discretionary, minus 8%, and retail, minus 9, almost 10% negative in 2 months and 1 week. That's a lot. 18 out of 28 sectors were positive, and 18 out of 44 sectors were positive. Last week, 28 out of 48 sectors were positive. So it's negative and moving in a negative direction. So this is the chart showing the S&P 500 over a 2.5-year period of time. I put on here a moving average. It's a 20-period moving average, meaning it is for every movement is 1 week. So out of whatever that is, out of 2.5 years, that's the number of weeks that there are, the number of moves. You can see that for the last year or so, a little more than a year, that every time the market went down a little bit, it went down and touched the moving average and bounced back up. Touched, moved back up. They did that 4 times. This time, the 5th time, it broke through the moving average. And that is not a positive sign. Now, you can see about a year and a half ago and other times that it has broken through the moving average and did not go all the way down and collapse. So I'm not saying because it went below this, that means that it's going to be an absolute collapse, but it could go lower. And but it's not a confidence sign when it breaks through the moving average. Now I put the same thing on a candlestick chart, and you can see where it came down that last period, that last week. The Friday was a positive day. The 5th was a positive day. So you can see that it actually, if you look at that candlestick on the far right, it went down a little further and then it came back up. And the coming back up was a result of Friday. NASDAQ versus the S&P. The NASDAQ has dropped below the ratio, meaning the NASDAQ, if it goes down, it favors the S&P. If it goes up, it favors the NASDAQ, growth stocks. So it has already dropped below the moving average, and this week it's slightly moved down just a little bit, again favoring the S&P as having more strength than the NASDAQ. Growth versus value. Now this kind of accentuates it because you're moving things into two camps. Growth stocks, Google, Apple, Microsoft, Facebook, etc., and value stocks, the old economy stocks. So when it goes up, it favors the growth stocks. When it goes down, it favors the old economy or value stocks. So you can see in the last couple of weeks, it has dropped radically, completely through the moving average, and that is favoring value stocks, which is basically a defensive indicator. Large cap versus small cap. Large cap meaning the S&P 500, the largest 500 companies in the stock market, compared to the Russell 2000, the 2,000 smallest companies in the market. So you're looking at a big separation. And when it goes up, it favors large companies. When it goes down, it favors small companies. So when you see at the far right of this, and I draw an arrow to show you, the far right favors large companies versus smaller companies, and by quite a bit because it's moving up quickly. Small cap has not done very well. I personally don't use a traditional asset allocation portfolio approach. I use active management, but the reason I don't use small cap or bonds, any kind of bond, is because of this. Because they are not as predictable. When they go out of favor, they really go out of favor. And this is an example of that. Long-term government bonds, TLT. Now you could use the short-term or intermediate term. They would all be moving in the same direction. And if you look, and this is a 5-year chart, so you can see where it's gone over 5 years, which means this is not good for, has not been good for traditional portfolios. Now, people may be using other kinds of bonds or bond funds or bond ETFs, granted. But in general, bonds have been negative. At the very far right, you can see the tick down. If you look very carefully at the very far corner right, a tick down. So bonds had, and you looked at it in the previous chart, the bonds had a negative week. They have been going up in the last month or so, but they've turned around and gone back down, which means when bonds are going down, that usually means interest rates are going up, or bond yields are going up, or there is the expectation they're going to go up. The US dollar has been falling for about a month. And you can see where it is. It's also broken through the moving average, and how far down is it going to go? I don't know. But I mean, what that means is that the US dollar does not go as far when you're buying or consuming products or services abroad, but it also means that those that are abroad, it is in their favor to invest in the US, spend dollars or invest dollars in the U.S. economy. Gold has gone up. You see the tick at the far upper right. Gold had a good week and is near its all-time high, or I shouldn't say all-time high, but the high for the recent intermediate term period. Silver, same thing, had a big move up, not quite at its intermediate term high, but getting closer. So good week for precious metals. Bitcoin had a slight move up. You can see that at the very far upper right. It moved up slightly, and it's not that far away from an intermediate term high. So here you have what's going on. Equities, negative. Bonds, negative. The dollar, negative. And precious metals, positive. Bitcoin, slightly positive. Volatility index, the VIX, finished the week at 2330. So I think on Thursday, I don't know the number, but I think on Thursday it went above my indicator at 24, and was anything above 24, in my opinion, is negative territory. So, but it finished the week slightly below the 24 number. As of Monday, with Monday being a negative day, maybe it's back above 24 at this point. So when it moves above 24, particularly when it's surging like this, that is not positive. Asbury 6 has 6 indicators. All of them have been negative, and they continue to be negative. When you compare the various asset classes, Asbury, bonds are stronger than equities. Low volatility is more favorable than high beta, high volatility. Large cap, as we've seen, stronger than small cap. Blue chips, the Dow, stronger than the broad market, the S&P 500. And the broad market, stronger than the NASDAQ 100. Value stronger than growth, developed markets stronger than the U.S., emerging markets stronger than the U.S. And when I say these comparisons, you can see the far 3 right columns, the last week, the last month, the last quarter. And they are all in sync with one asset class being stronger than the other. And I would say, I think a lot of this is due to trade wars and tariffs, or fear of those. What are those going to mean for us? And the market hates uncertainty, so as a result, the market is shaking right now as a result of the perception of those. Government bonds stronger than corporate bonds. So government bonds are have not done too well. I guess maybe over 3 months, or a week and a month, maybe they have. But if that's the case, corporate bonds are even worse. So that's kind of the read for all 3, the ones that are consistent for all 3 time periods. Okay, now, U.S. versus the world. Now, this is not the economy, this is not the currency. This is the market in each of these countries, represented by an ETF that represents that company. So comparing the U.S. to Chile, Brazil, Peru, Canada, Mexico, Switzerland, Italy, Germany, Spain, France, UK, Eurozone, Japan, Hong Kong, Singapore, Taiwan, South Korea, China, and the Pacific. Now that's a long list. All of those are doing better than the U.S. for the last week, the last month, the last quarter. Again, go back to my earlier message. I think it's probably due to the tariff situation, or the fear of that, the potential of that. There are no exceptions. There are no exceptions where the U.S. has done better than all of these, than the remaining countries for all 3 time periods. So a pretty definite story about where the markets are going internationally. Now, in the past, I've shown you the U.S. versus South Korea. This is a 4-year chart using a relative strength of the U.S. SPY versus EWY, which is the South Korea. And over 4 years, you can see the degree to which the U.S. has outperformed South Korea, meaning it goes up, or periods when it has come down, where that means South Korea has outperformed the U.S. by that much. In the last, I'm going to say month and a half, South Korea has outperformed the U.S. Prior to that time, you have a pretty long period here where the U.S. outperformed them, again, from a stock market perspective. Precious metals, gold and silver. So as of last Friday, gold was up 1.9% for the week compared to the previous Friday, to a price of $2,912, getting close to that 3,000 number, and looks like it wants to break through 3,000. Silver, this is the spot price now. Silver is $32.65 per ounce, a 3.7% increase over the previous Friday, bringing the gold-silver ratio to 89-1. A monster box, you can see what one looks like, is 500 rounds of generic silver. That sells for, as of Friday, $16,845. That includes the base price of the spot price, plus the markup of $1.04, to a total of $33.69 per ounce. Times 500 is your $16,845. This is courtesy of my son Preston, who's in the precious metal business. What's the abbreviation for the U.S. Treasury 10-year bond? And even worse, you could say the 20-year bond. ADHD. There you go. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And if you're not a subscriber, please hit the subscribe button. It does help our distribution. Thank you.